85% of experienced traders destroy entire accounts, not from lack of technical signals or entry timing, but because they calculate position sizing in completely wrong ways, treating risk management as simple mathematical percentage. When the market moves against their positions with volume of 20,000 contracts and volatility explodes to 50 points per hour, they feel their chest tighten and hands shake, realizing that position size transformed a normal correction into existential threat. The spread widens from 2 to 6 ticks, while 15-minute candles form descending gaps, and even traders with years of experience discover their accounts cannot withstand drawdowns that should be routine, forcing them to close positions at the worst possible moment, with eyes fixed on screen and breathing accelerated by financial pressure. The fundamental flaw stems from confusion between nominal risk and real risk, where traders define position sizing based only on monetary value they're willing to lose, completely ignoring how volatility and market correlation amplify exposure exponentially. This simplistic approach only works in stable markets with low volatility, but becomes lethal during stress periods when correlations converge to one and movements become non-linear. The rule that separates survivors from the destroyed is calculating position sizing based on current instrument volatility multiplied by correlation with other portfolio positions, not fixed account percentages. Professional traders adjust position size inversely to realized volatility of the last 20 periods, ensuring real exposure remains constant regardless of market conditions. When applied correctly, this methodology allows aggressive operation during low volatility and defensive operation during high volatility, maintaining consistent risk versus reward in any environment. This video will reveal the exact mathematical formula that institutional traders use to calculate dynamic position sizing, including how to adjust exposure in real time as volatility changes throughout the day. You'll discover why this approach is systematically omitted from traditional courses, and how to implement it immediately to transform risk management from vulnerability into competitive advantage. Subscribe now to receive rules that can change your results in advanced risk management and access technical content that simply isn't disclosed anywhere else in the trading community. Stay until the end to discover the definitive checklist that differentiates amateur traders from professionals in applying position sizing that actually protects wealth. Nominal risk is what you calculate on the spreadsheet before entering the trade, while real risk is what can actually destroy your account when the market moves against you. Most traders define 2% risk per trade based on account value, ignoring that this calculation becomes irrelevant when volatility explodes and correlations converge. If you trade mini-index risking 500 reais per contract, but the market is in high volatility regime with 50-point movements in 15 minutes, your real risk can be 3 times higher than calculated. The problem isn't mathematical. It's conceptual. You're measuring distance when you should be measuring impact velocity. This confusion kills experienced accounts that survived years operating with apparently conservative management. Correlation between positions transforms individual risk into systemic exposure that few traders can adequately quantify. When you're long 3 mini-index contracts, short 2 financial sector stocks, and positioned in dollar futures, you believe you're diversified with independent risks. During market stress, correlations that were historically low jump to 80 or 90%, meaning all your positions move in the same direction simultaneously. A 2% movement against you in the index can result in 5% real account loss, because all correlated positions amplify the impact. Monitor 30-day rolling correlations between your preferred instruments and reduce exposure when correlations exceed 60% between assets you consider unrelated. Apparently normal drawdowns destroy accounts because traders calculate risk based on average volatility, not extreme volatility that defines survival. A trader operating for 2 years may be accustomed to 5 to 8% drawdowns, considering them normal part of the process. When the first 15% drawdown arrives, which statistically happens to every experienced trader, the account can't withstand it because position sizing was calibrated for historical volatility, not for extreme but inevitable events. Calculate your position sizing based on the worst drawdown you can psychologically tolerate multiplied by 2, not the average loss you expect. This additional buffer is the difference between surviving the first major stress and joining the statistics of traders who almost made it. Fixed percentages fail during stress because they assume volatility remains constant, when in reality it changes dramatically between market regimes. 2% position sizing works perfectly when daily volatility is 1%, but becomes suicidal when volatility jumps to 5% due to macro events or regime changes. During March 2020, traders who maintained fixed position sizing saw accounts disappear in days, while those who adjusted exposure according to volatility managed not only to survive but prosper. Implement a volatility multiplier in your calculation. When realized volatility exceeds historical volatility by 50%, reduce position sizing proportionally. The simple formula is new position equals base position multiplied by historical volatility divided by current volatility. Practical examples reveal how inadequate position sizing creates invisible traps that explode at the least expected moment. A day trader operating mini index with 20-point stop and 60-point target believes he has 1 to 3 risk reward, but ignores that during high volatility sessions, slippage can transform 20-point stop into real loss of 35 points. Position sizing calculated for 20 points of risk becomes inadequate when real risk is 75% higher. For scalping in normal conditions, use structural stops based on technical levels for day trading during high volatility. Add 50% buffer to the stop for swing trading. Incorporate overnight gap risk by calculating close to open volatility from the last 60 sessions. The fundamental rule is simple. Always calculate position sizing based on the worst realistic scenario, not the expected average scenario. Realized volatility is the thermometer that measures market fever, but most traders use this thermometer wrong, or simply ignore its readings. Calculate 20-period realized volatility using standard deviation of logarithmic returns, not simple percentage variations that distort mathematical reality. For a trader operating mini index, take the last 20 closes, calculate natural logarithm of each close divided by previous close, then apply standard deviation to resulting series and multiply by square root of 252 to annualize. This number reveals the real speed at which market can move against you, regardless of current price direction. When realized volatility jumps from 15% to 40% annualized, your effective risk triples, even maintaining the same absolute position sizing. The distinction between historical and implied volatility determines whether you're operating based on what already happened or what the market expects to happen. Historical volatility looks backward, measuring past movements that may not repeat in upcoming sessions. Implied volatility, extracted from options prices, reveals market consensus about future movements and frequently anticipates regime changes before they appear in historical data. When implied volatility exceeds historical by more than 20%, the market is pricing disruptive events that your analysis based on past data cannot capture. Configure alerts for significant divergences between these two metrics: rising implied volatility with stable historical signals, imminent turbulence that justifies immediate exposure reduction. During known events like monetary policy meetings or important economic releases, implied volatility can double in hours, transforming apparently conservative operations into high-risk bets. Non-linear movements destroy accounts because they amplify losses exponentially, not proportionally as inexperienced traders assume. In normal markets, if the index falls 1%, your positions lose approximately 1% multiplied by leverage. During stress, that same 1% movement can result in 3 or 4% losses due to second-order effects, increased slippage, exploding correlations, bid-offer gaps that widen dramatically. The phenomenon happens because liquidity evaporates exactly when you need it most, forcing executions at progressively worse prices. To identify non-linear regime, monitor the relationship between price movement and volume. When volume triples, but price moves only 50% more than normal, there's abnormal liquidity absorption that precedes explosive movements. This is the moment to drastically reduce position sizing, not add positions because they seem cheap. Precise identification of volatility regimes allows adjusting exposure before regime changes destroy your account. Low volatility regime is characterized by 20-day realized volatility below 60-day moving average, daily volume consistently below average, and intraday ranges not exceeding 1 standard deviation from historical mean. During these periods, position sizing can be increased up to 50% because probability of extreme movements is statistically low. High volatility regime emerges when 20-day volatility exceeds 60-day average by more than 2 standard deviations, volume explodes above 90th percentile and intraday ranges frequently exceed 2 standard deviations. In these moments, reduce position sizing by half and increase monitoring frequency of all open positions. Transition between regimes is rarely gradual, most usually happens in 1 or 2 sessions, requiring automatic risk reduction protocols. Correlation during stress reveals how apparent diversification transforms into risk concentration when you most need protection. During calm markets, correlation between both SPA index and individual stocks may vary between 30 and 60%, creating illusion of real diversification. When stress hits the system, correlations converge to 80 or 90% within hours, meaning your diversified portfolio behaves like one giant position. Measure 15-day rolling correlations between all instruments you operate, and configure alerts when average portfolio correlation exceeds 70%. During these periods, reduce total number of positions, instead of trying to diversify between instruments that behave identically. The practical rule is simple: when correlations explode, focus on quality instead of quantity of operations, prioritizing only setups with highest success probability, and eliminating marginal trades that add risk without adequate compensation. The equation that funds use to calculate position sizing is mathematically simple, but its correct application requires discipline that most traders cannot maintain. Optimal position sizing equals available capital multiplied by expected trade return, divided by annualized volatility squared, multiplied by correlation adjustment factor. This modified Kelly formula ensures exposure remains constant in real risk terms, regardless of market conditions or instrument operated. For a trader with 100,000 REITs capital, 2% return expectation per trade, 20% annualized volatility, and 40% portfolio correlation, position sizing would be 100,000 times 0.02 divided by 0.20 squared, multiplied by 0.6, resulting in 3,000 REITs per operation. The formula's beauty lies in automatic inversion. When volatility doubles, position sizing drops by half, maintaining constant absolute risk. Portfolio correlation incorporation transforms individual position sizing into systemic management that considers interactions between all positions. Calculate weighted average correlation between intended position and all existing portfolio positions, using weights based on relative size of each position. If you're already long 3 mini-index contracts and want to add 2 financial sector stocks with 70% historical correlation factor would be 0.70 multiplied by proportion of capital already allocated in index. Position sizing for stocks should be reduced proportionally to correlation squared, because risk amplifies geometrically, not linearly. Configure spreadsheet that automatically calculates portfolio weighted correlation every time you consider new position when total correlation exceeds 50%. Reduce position sizing of all new operations by half until correlation returns to acceptable levels. Adjustment based on maximum tolerable drawdown anchors the entire system in traders' psychological reality, not abstract mathematical optimizations. First, define the largest drawdown you can withstand without altering your operational methodology. Might, usually between 10 and 20% for experienced traders. Divide this number by 3 to obtain your conservative drawdown target. Then use operation history to calculate how many consecutive losing trades have already happened in last 2 years. Multiply consecutive losses number by 2 for safety buffer. Then calculate position sizing that ensures even this prolonged losing sequence doesn't exceed your target drawdown. For trader who tolerates 15% maximum drawdown with 5% conservative target and history of 6 consecutive losses, maximum position sizing would be 5% divided by 12 operations, resulting in 0.4% per operation. This calculation seems conservative, but it's what separates traders who survive decades from those who blow up in 2 to 3 year cycles. Position sizing varies dramatically between timescales because each time frame has specific risk and return characteristics. For scalping on 1 to 5 minute charts, use more aggressive position sizing because stops are structurally smaller and operation frequency allows statistical diversification within same day. Calculate intraday volatility from last 10 sessions, and use only half Kelly formula to avoid emotional overtrading during rapid loss sequences. Day trading on 15 to 60-minute charts requires medium position sizing that balances opportunity with zero overnight risk, using 20-day volatility as calculation base. Swing trading requires more conservative position sizing because overnight and weekend event exposure multiplies gap risk, requiring additional 30% buffer in calculated volatility. Practical rule is reduce position sizing by 20% for each additional day of planned holding period, reflecting temporal risk accumulation that few traders can adequately quantify. Backtesting validation reveals whether your position sizing formula actually works in real market conditions, not just theory. Build database with all your operations from last 12 months, including trades rejected by filters, and recalculate position sizing using institutional formula for each entry. Compare maximum drawdown, total return and Sharpe ratio between old and new methodology to quantify real improvement. Execute tests in specific sub-periods, January to March 2020 for extreme stress, July to September for low volatility, November to December for elevated seasonal volatility. If formula doesn't improve performance in at least 2 of 3 periods, adjust volatility or correlation parameters until finding configuration that works consistently. Backtesting doesn't guarantee future performance, but eliminates formulas that provably fail in adverse conditions that will certainly return. Execute this validation process quarterly, adjusting parameters as market characteristics evolve and your own risk tolerance changes with accumulated experience. Automated spreadsheet configuration eliminates emotional decisions during operation heat, transforming position sizing calculation into mechanical and reliable process. Build spreadsheet with 5 main columns: available capital, current instrument volatility, correlation with existing positions, trade return expectation, and automatically calculated resulting position sizing. Use Google Finance function or API connection with your broker to feed real-time prices, calculating 20-period volatility automatically with each update. Configure conditional formatting that highlights in red when calculated position sizing exceeds 3% of capital, or when total portfolio correlation surpasses 60%. For traders operating multiple instruments, create separate tabs for each time frame with specific parameters: scalping tab with 15-minute recalculation, day trading tab with hourly recalculation, swing trading tab with daily recalculation. Automation should include history of all position sizing decisions for posterior efficacy analysis. Recalculation frequency should reflect operational speed of each strategy, avoiding both information lag and over-engineering that paralyzes execution. For scalping on 1 to 5 minute time frames, recalculate position sizing every 10 operations, or when intraday volatility changes more than 20% relative to session average. Day trading requires recalculation every 2 hours, or when significant macro events alter volatility regime, captured through automatic alerts of abnormal volume or price movements exceeding 2 standard deviations. Swing trading allows daily recalculation at close, incorporating overnight volatility and adjusting for known next-day events. Configure forced recalculation alerts when correlation between your positions jumps more than 15 percentage points in any direction, indicating regime change that invalidates previous calculations. Practical rule is recalculate position sizing whenever market conditions change significantly, but never during specific operation execution to avoid analysis paralysis. Integration with trading platforms automates execution based on calculated position sizing, eliminating manual errors that destroy operational discipline. Configure your platform to accept orders only with sizes pre-approved by spreadsheet, blocking impulsive executions that exceed calculated risk. Use conditional order functions to implement progressive position sizing automatically. First order with 50% of calculated size, second order with 30%, if first confirmation level is hit, third order with remaining 20%, only if second level is conquered with adequate volume. For platforms that don't offer direct integration, use visual and sound alerts that trigger when you try executing order outside approved parameters. Maintain automatic log of all executions with timestamp, order size, approved position sizing, and deviation between planned and executed. This history reveals indiscipline patterns that sabotage even the best risk management systems. Specific adjustments between high frequency and long positions Recognize that different operational speeds require completely distinct risk management approaches. High-frequency operations allow more aggressive position sizing because statistical diversification happens throughout dozens of trades on same day, reducing risk through law of large numbers. Use 1.5 multiplier on basic Kelly formula for scalping, but implement rigid stop-loss of 10 consecutive losing trades that forces 2-hour pause for reassessment. Long positions require more conservative position sizing because overnight event exposure and gaps multiply tail risk that formulas based on normal volatility don't capture. Reduce position sizing by 50% for operations held overnight, and by 70% for positions crossing weekends. For swing trades that traverse important economic releases, add extra 20% buffer to calculated volatility. Differentiation between speeds is crucial. High frequency diversifies through quantity, long positions need to diversify through selection quality. Treatment of gaps and extreme events requires specific protocols that most traders ignore until facing first tail event that devastates accounts. Configure automatic 50% position sizing reduction during weeks including monetary policy meetings, inflation releases, or known geopolitical events. For operations crossing market closures, calculate gap volatility using difference between closes and opens from last 60 sessions, adding this component to normal intraday volatility. Implement automatic circuit breakers that liquidate all positions when intraday drawdown exceeds 2/3 of previously defined maximum tolerable drawdown. During systemic stress periods identified by implied volatility above 95th historical percentile, reduce position sizing to 20% of normal levels until conditions normalize. Always maintain capital reserve never below 30% of account to capitalize on opportunities arising during extreme dislocations, when other traders are forced to liquidate positions at distorted prices. These rare events define long-term performance more than hundreds of routine operations. Continuous volatility monitoring during trading session requires system that detects regime changes before they destroy existing positions, not after loss has already materialized. Configure alerts that trigger when 1-hour rolling volatility exceeds daily average volatility by more than 50%, indicating acceleration that may persist for hours. Use exponential moving averages of volatility with 5, 15, and 60-minute periods to capture changes at different speeds when all three averages align upward with divergence exceeding 20%. There's emerging high volatility regime justifying immediate exposure reduction. For instruments highly correlated to main index, monitor index volatility as proxy for entire market, adjusting individual stock position sizing when systemic volatility explodes. Configure separate charts showing only intraday realized volatility updated every 15 minutes, facilitating visual identification of spikes preceding extreme movements. The key is acting on volatility change, not price change that already incorporates the new regime. Automatic reduction protocols during spikes eliminate decision paralysis when execution speed determines account survival. Program conditional orders that reduce position by half when intraday drawdown reaches 50% of maximum tolerable, and liquidate completely when reaching 80%. Configure 3-level alert system: yellow when intraday volatility exceeds average by 30%, orange when exceeding by 60%, red when exceeding by 100%. At yellow level, stop opening new positions. At orange, reduce existing positions by 30%. At red, liquidate everything except positions with profit exceeding 200% of initial risk. Use dynamic trailing stops that automatically adjust to current volatility when volatility doubles. Stops widen proportionally to avoid premature exits in new regime's normal noise. Automation must be complete because manual decisions during stress are consistently inferior to predefined protocols executed mechanically. Alert signals for regime changes. Capture transitions before they become obvious through extreme price movements. Monitor 15-minute rolling correlation between different sectors. When correlation jumps from 40 to 80% in less than 1 hour, there's emerging systemic stress preceding coordinated movements in all positions. Configure alerts for abnormal volume when hourly volume exceeds same hour average from last 20 sessions by more than 300%. Without obvious fundamental news, there's privileged or algorithmic information moving market. Observe bid-offer spread behavior. Sudden and sustained widening indicates liquidity evaporation preceding gaps and elevated slippage. Correlation monitor should include relevant international instruments when S&P 500, Euro and oil start moving in uncommon synchrony. There's global macro event affecting all markets simultaneously. These signals appear 5 to 30 minutes before price movements become obvious, offering critical window for exposure adjustment. Rebalancing when correlations converge transforms apparent diversification into real concentration that must be managed immediately. Calculate portfolio weighted average correlation every hour during volatile sessions when exceeding 70%. Implement deconcentration protocol that prioritizes liquidity over timing. Sell smaller and less liquid positions first to preserve flexibility, maintaining only main positions with higher conviction. During extreme convergence above 85% correlation, consider temporary hedging with inverse positions instead of total liquidation, especially if market timing suggests imminent reversal. Use inverse ETFs or put options for quick hedge when direct liquidation would imply significant slippage. Configure system that automatically suggests non-correlated instruments based on historical analysis. When equity correlation rises, system should suggest bonds, commodities, or currencies with consistently low correlation. The objective isn't eliminating risk, but redistributing it among instruments that maintain independent behavior even during stress. Validation checklist before each operation functions as final filter, preventing execution of trades violating dynamic risk management protocols. First is current volatility within 2 standard deviations of 20-day average. If not, reduce position sizing by 50%. Second is new position correlation with existing portfolio below 60%. If not, recalculate position sizing including correlation factor. Third is current account drawdown below 50% of maximum tolerable. If not, operate only with 20% of normal position sizing. Fourth, are there known macro events in next 24 hours that may affect your instrument? If yes, add extra volatility buffer. Fifth, is alert system functioning and configured correctly? If not, operate only with minimum position sizing until resolving technical issues. Sixth, can you actively monitor position during next 2 hours? If not, use only position sizing allowing automatic stop execution without supervision. This checklist must be executed religiously before each trade, transforming risk management from vague concept into verifiable process that can be audited and continuously improved.